I'm Yaneli, also known as Miss Be Helpful, with another FinCap Friday brought to you by NGPF. Back in early 2019, if you searched online for the interest offered in a high yield savings account, it would have been about 1.5%. By early 2020, it was about 2%. And by early 2023, it was as high as 5%. But don't get it twisted. This doesn't mean that interest rates on savings accounts just go up and up and up. Sometimes they drop to a lower rate too. But most people have no clue what exactly makes the interest rates for savings accounts go up or down as time goes on. So let's get into it. First up, there's inflation. When inflation is low, the Federal Reserve, which is the central bank of the United States, tends to keep interest rates low as well because they want to stimulate the economy by encouraging more borrowing and more spending. So this often results in lower savings account rates offered by financial institutions. But when inflation is high, it eats away at the value of our dollars that we hold inside our savings accounts over time. So that's why banks and credit unions might offer higher interest rates on savings during high inflation times, because they want to help their customers and members maintain the purchasing power of their dollars held in their savings accounts. Next up is the interest rates set by the Fed. When the Federal Reserve sets an interest rate, it actually establishes how much it costs for one bank to borrow from another. So when the Fed raises rates, it becomes more expensive for banks to borrow money, which can lead to a decrease in their profitability. And when the Federal Reserve lowers rates, it becomes cheaper for banks to borrow money, which can increase their profits. That's why banks typically adjust their savings accounts' interest rates in response to the changes made by the Federal Reserve with the interest rate set by them. When the Fed raises interest rates, banks want to increase their savings account rates too, in order to attract more deposits and maintain enough funding so that they can continue to do their lending activities. But when the Fed lowers interest rates, the banks will follow and lower their rates too, because they want to reduce their funding costs and maintain their profits. We also have to consider the fact that banks have to stay competitive within the financial industry if they want to stay relevant and continue to do well. So when new banks, new apps, or new online banks offer higher rates on savings, this leads to higher rates on savings accounts from traditional banks too. Most banks try to offer the highest rate that they can without hurting their profits too much, because they do want to attract new customers, but they also have to keep in mind that they want to keep somewhat of a competitive advantage. Finally, there's the economy. During a period of economic slowdown, the demand for credit and borrowing decreases, which means lower interest rates offered by the banks. But on the flip side, when there are times of economic growth, banks are going to see more profits. And that's why they might offer higher interest rates on their savings accounts, because they will want to attract more deposits so that they can make more loans with those deposits. And in the end, that will help them maintain their profitability. So now you have a better idea of what makes interest rates on savings accounts go up or down over time. But if you don't know what the highest interest rates being offered in savings accounts right now would be, it's a good idea to do some research on that, because you always want to make sure that you're getting the most interest on your savings to help you grow your wealth and to fight back against inflation.